Why does almost every wealth advisor in the country say to hold your mortgage and invest the difference? And when exactly is that precisely wrong? This video is two questions. The first one has a clean answer that gets taught in every wealth management training program. The second one doesn't get said out loud because it's the one that loses the client. Same house, same neighborhood, same Civic in the driveway at 45. But the line on the monthly statement that read mortgage for 10 years now reads zero. $300,000 of interest didn't get paid. By the end of this video, you'll know whether that was the right call for you and the one paragraph in your advisor's script that decides which side of 45 you're on. Start with the script itself. The phrasing is consistent across firms. It sounds like this. At today's rates, you're better off keeping the mortgage and investing the difference. The market historically returns about 10%. Your mortgage is around 6.5. The spread is in your favor. That's the line. It gets delivered with confidence because the math holds up in the abstract. Let me take it apart. Freddie Mac publishes a primary mortgage market survey every Thursday. It tracks the average 30-year fixed mortgage rate across the country in real time. Their recent data has been hovering in the 6.5 to 7% range. Call it 6 3/4 as a working assumption for this video. That's the actual rate the advisor's script is referencing. Imagine a $400,000 mortgage at 6 3/4% over 30 years. The monthly principal and interest payment lands at about $2,590. The total interest paid across the life of the loan is right around $530,000. That's the script's first number. Now the alternative the script offers: pay the minimum on the mortgage. Take the cash you would have used to pay it down faster, call it $2,000 a month, and route it into an index fund. Over the same 30 years, at the long-run S&P 500 nominal rate of about 10%, the account compounds to somewhere around $4.5 million. Run the numbers yourself in any compound calculator. $4.5 million versus the $530,000 of interest paid. The spread looks decisive. The script wins on paper. So is the math wrong? No, the math is exactly right under the assumptions it makes. That's the first question answered. The script exists because the math, taken at face value, supports it. Now the second question. What actually happens when the script meets a real household? The Federal Reserve publishes a survey of consumer finances every 3 years. Their 2022 edition has a section on mortgage debt by age cohort. I keep coming back to one figure in it because it's quietly the entire answer to the second question. The median 45-year-old American homeowner still has somewhere around 2/3 of their original mortgage balance outstanding. Not because they couldn't have paid more, because the cash flow that would have gone toward extra principal slowly redirected it into a second car, into a larger house refinance midway through the term, into a vacation property, into lifestyle changes that the freed up monthly made possible. Where does the difference actually go? Watch the cash flow across a decade. Year 1, the household genuinely invests the extra $2,000. Year 2, mostly. Year 3, partially. The new lease ate some of it. Year 5, the refinance dropped the monthly by $300. But somehow the brokerage contribution didn't go up. Year 7, the kids are older. The schedule is more expensive. Year 10, the extra $2,000 a month is invisible. It was absorbed. That's what the data says. The difference that the script assumed would get invested didn't get invested. It got absorbed. The part the advisor does ask about is whether you're the version of yourself that holds the line or the version that absorbs it. The advisor assumes you're the version that follows the plan. The data says most people are the version that doesn't. So when is the script correct? I'd put it this way. 3 conditions have to hold simultaneously. 1, you're a high-conviction long-term investor who actually does invest the extra payment every month in a fund automatically without touching it. 2, your tax situation makes the mortgage interest deduction meaningful. Since the standard deduction roughly doubled in 2018, most American households don't itemize anymore. That means the mortgage interest deduction provides zero actual tax savings for them. 3, your income is stable enough that paying the mortgage off slower doesn't create cash flow risk during a job loss or income disruption. All three, not two. If you're high conviction but don't itemize, the script tilts toward paying down. If you itemize but have variable income, the same. If you have stable income and itemize but won't actually invest the difference, the script falls apart entirely. Put a calculator next to you. Check it against your last tax return. The math behind the script depends on assumptions about you that you can verify on a single sheet of paper. So when does the script become a sales phrase rather than advice? Watch the cash flow. The wealth management firm earns its revenue as a percentage of the assets it manages. The accounts under management generate the fee. Every dollar that leaves the brokerage to pay down a mortgage is a dollar that stops generating the fee. The script doesn't say this. It doesn't need to. It just reliably points the client's surplus cash toward the brokerage account and away from the mortgage principal year after year until 30 years pass and the original balance is still mostly there. The honest version of this, the one I don't usually say in mixed company, is that the script isn't malicious. The math really does support it under three conditions. It's just that the three conditions get assumed silently. The data on whether they hold gets skipped over. The result is that the client behaves as the script predicts, even when they don't fit the conditions. Compare it to where you were a year ago. If your liquid investments grew, but your mortgage balance is roughly the same, the script ran on you. That's not blame. I think of it as the observation. I had a conversation a few years ago with someone who paid off a $400,000 mortgage in 9 years. They were 36 when they signed the loan. 45 when the bank closed the file. The morning the discharge letter arrived, they didn't tell anyone. They drove the same Civic to the same office that Tuesday. The neighbor across the street was still on year 17 of his 30 year. The asset allocation conversation for their next decade was different from the conversation everyone else was having, but the surface of their life looked the same. What they had bought was time, not the kind that gets advertised, the kind where the monthly that used to pay the lender comes back to your statement and decides whether you keep doing what you're doing or stop. There's a version of this story that ends differently. I see it more often than the discharge letter version. Year 7 of the 30 year. The household refinances to a slightly lower rate. The new term starts at 30 years again. The monthly drops by $200. The household feels like they saved money on the refinance. Nobody adds up that the 7 years they already paid into the original mortgage just got reset. Year 0 of a new one. I think the refinance trap is the actual mechanism. It delivers the median 45-year-old to the spot the Federal Reserve survey finds them in. Not because they're undisciplined, because the math of the refinance is presented in monthly savings terms, not in lifetime interest terms. The script that says refinance into the lower rate is the same script that says hold the mortgage. Both push the loan term back out to 30 years. Both keep the household paying interest into the late 50s. So how do you know which version of the script applies to you? One step back. NetSum does something the other channels in this space skip. It shows the cadence between the levels, not just the levels. The number, the regular Wednesday, the call that adds up. If that detail matters to you, subscribe. That's the direction. Here's the operational check. 3 questions to answer honestly before you decide which side of the script you're on. 1. What's your mortgage rate exactly? Open your mortgage statement right now. You'll see it on the first page, usually under interest rate or note rate. If it's below 5%, the script tilts toward holding. If it's between 5 and 7, it depends on the other two conditions. If it's above 7, the script tilts toward paying down regardless of the rest. 2. Do you itemize on your tax return? Pull last year's Form 1040. If you took the standard deduction, the mortgage interest deduction didn't save you $1. The script silently assumes you itemize. Most households don't. 3. If you freed up $2,000 a month, would it actually go into the index fund every month, or would it slowly redirect into living expenses, lifestyle creep, a slightly nicer car, a slightly nicer vacation? Look at this moment, right now. Be honest. The answer is, what decides which side of the script you're on? 3 questions, 3 answers. The combination tells you whether to follow the script or break from it. Not your advisor's interest, not the firm's revenue model, yours. The math behind paying it off faster, by the way, isn't dramatic. A $400,000 mortgage at 6.5% paid off in 10 years instead of 30 saves somewhere between $300,000 and $400,000 in interest depending on the exact rate. The monthly required to make that happen is closer to $4,600 instead of $2,500. $2,000 a month more for 10 years. After year 10, the entire payment comes back to your statement and stays there. That's the actual exchange. $2,000 a month for 10 years to get the next 20 years of monthly back. Without the lender's piece, without the cadence the script assumed would stay running for 3 decades. 45. Tuesday morning. Same driveway, same Civic, 10 years older. 230,000 miles. Still running. The neighbor's house across the street still has 18 years of mortgage left on it. Same paycheck range, same neighborhood, same car class, same coffee in the same kitchen. But the line on the monthly statement that used to read mortgage for 10 years now reads zero. The monthly came back to the asset sheet. Nobody on the street knows. What does the rest of the asset allocation conversation sound like the morning after the discharge letter? It sounds different from the conversation everyone else is having. The cash flow that used to fund the mortgage now funds whatever you decide. The household survived the job loss differently. The retirement projection moves up by something like 4 years. The decision set is wider for the rest of your 40s and 50s because the largest fixed expense is gone. The script didn't run on this version. The math the script was built on still worked, the index fund still grew, just on a smaller monthly because the larger one was going to the principal. The trade was less mathematical optimization and more cadence sovereignty. $300,000 of interest didn't get paid. The line went to zero. The asset sheet noticed even if nobody else did.